Okay, well, good afternoon, everybody. Welcome to the new world of webinars. It's a shame that we can't actually all see each other and shake hands and particularly maybe even have a glass of wine, but it's very nice of you to join us all. So can I first of all just give you a little bit of a background in terms of what we're going to do as the process. So we have put you all on mute at the moment, but there will be an opportunity for you to post any questions as you go along. If you use the questions button on the Zoom facility, and if anybody's got any particular questions that we don't get round to answering, then we can take that up with you separately. If there's something particularly relevant that's posted as we go along, we'll stop talking and we'll answer that question. But by and large, I think we're going to answer these questions towards the end of the session. So I don't know the demographics of the audience that I'm talking to here, but for those of you who were born in the 1960s, you may remember an advertisement that was called the Remington shaver, and it was about a guy who was demonstrating the benefits of this new dry shaver, and his closing words were, "I like the product so much I bought the company." And so I'd like to open this with, I like the employee ownership so much that I've actually implemented it in my own company. And so I don't really think there's very much more that you can say about how positive I think about this particular product. So first of all, I'd just like to introduce you to our lovely specialist partners that we've brought together to deliver a very full and comprehensive solution. So this is myself. I am Jo Haig. I am the CEO of FDS, because that's right, I'm still remaining a CEO in our employee-owned business. And I have been running my business for near on 30 years, and we've completed over that process about 400 different transactions, and that's including several of my own. So I've sat on both sides of the table. I'm then delighted to have with us Paul Trudgell, who is one of the senior partners at Keebles, who are a full service commercial law firm, and it is Paul's business who have helped my own company through this transition to an employee ownership trust. And Paul's got vast experience in pulling together the right documentation to provide protection for both parties. And finally, Russell, who is our tax advisor. And again, as with Paul at Keebles, Russ has been an important part of the party in our own transaction. So we believe we have got the best team possible to deliver an employee ownership trust service for you to suit your business needs. So what I'd like to do first of all is just to explain to you what an EOT is. So an EOT is basically a trust company that owns some or all of the shares on behalf of the staff. Now, in my particular case, I have actually transferred 89% of my shares to the trust, but you can transfer any amount as long as it is more than 50%. So more than 50% has to be transferred into the trust. Now, when Russ comes to tell you about the tax issues on this, the thing to remember is that if you transfer over not the whole 100%, any deficit you will not be able to transfer over in the tax effective way that I'm going to explain shortly. In other words, you only have one shot at transferring at nil capital gains tax. So the beauty of this is twofold, in that not only does it allow the staff to participate in the profits of the employee ownership trust, but it also allows you as the vendor to transfer or business to your staff, the next generation, with no personal cost to them, unlike a management buyout, where nearly always there is some requirement for the team to put in sometimes as much as 2 years' salary. And for me, it was very important that I rewarded my staff who have been instrumental in helping me build my business. And although I probably could have gone out and looked at a trade sale, and I certainly could have looked at a management buyout, this was so much more effective because I have a young team and they don't have lots of assets, and this enabled them to take over the business without putting themselves in a huge amount of debt. It also was nice to say thank you to them for all the hard work. Of course, what it also does is it helps you attract and retain the staff. So attracting new talent is very important. And although we're probably facing some of the most devastating employment figures that some of us will have seen in our lifetime, we all know that the right staff are not necessarily the ones who are available. So it's very important that once you have got those key members of talent in your business, that you do everything you can to retain them. And once you have staff ownership, clearly as an owner, there's a different position of how you regard working in that business. So I sort of just mentioned briefly at the start of this, that as a vendor, one of the brilliant benefits of this scheme is that unlike any other stock transfer, unless you're going to go and live somewhere internationally for, I think it's a minimum of 5 years, but I'm sure Russ will enlighten me to that. This is the only way that you can take out the proceeds of your business sale completely tax-free. So there is no capital gains tax at all, no income tax. It's also much, much quicker than doing an MBO or a VIMBO. And for those of you that don't know what a VIMBO is, VIMBO stands for Vendor Initiated Management Buyout. And that's where the vendor and the management team tend to work together to come up with a valuation and indeed define funds. But as already mentioned, the management team almost certain will have to put between 1 and 2 years' salary in. So in order to actually fund that, that puts an awful lot of pressure on the team who are running the business. Of course, it also takes considerably longer to do this. Likewise, a trade sale can take as long as a year, and even a friendly MBO or VIMBO can take 6 to 9 months, whereas a well-positioned and well-structured EOP can take as little as 3 months. And we've done it in 3 months, and that is mid-COVID, where of course a lot of professionals that have been on furlough and company house have been slower than they might normally be. Without a doubt, it was very important to me because culture and values are a huge part of our DNA. And one thing that doing an EOT allows you to do is to ensure the integrity of that is maintained. And as we are a service business, who we are and what we stand for is extremely important to me. I've spent 30 years building up those values. And of course, it makes for a more collegiate business. And just to share with you a personal insight into this, when we actually announced it to our staff, they were so overwhelmed at the opportunity. And I was delighted to be able to do that for them. So you get a much more collegiate business where we're all working together. I thought it would be interesting for you to see the sort of the process of what happens, because while I've said it is considerably easier than a trade sale or even an MBO, there is a process that has to be followed, and it's very important to get this right, which is why we've spent time assembling this great team. Clearly, when you do this sort of process in your own business, I wanted to make sure that the people who were helping me were good enough to help our clients. So the first thing we have to do is to assess, is this process right for your business, right for your organization? And Russell will tell you later if there are any things that might make your business less suitable than others. Of course, you are selling your business if you're the vendor listening to this webinar, so the valuation has to be robust. And at FDS, we would provide you with a valuation which would be market researched, and so that if there was ever any queries from HMRC, you can be confident that those numbers can stand up in their own right. We then pass that valuation over to our lovely Russell and a tax company to ensure that we get HMRC approval. That can take a matter of weeks, but it's certainly generally not a matter of months. Now, of course, the valuation has to be paid for, and in my own business and perhaps in some of yours, how I'm structuring that is that the excess cash in the business will come straight out and to me as vendor, and then the rest of the payment will be structured over a period of time from the profits of the business. However, it is absolutely possible for the EOP to borrow money to fund that deficit, and that is usually via a cross guarantee with the selling company. And of course, we can help you with that. I mentioned when I was just introducing myself that I am remaining a CEO, but we do know that some vendors want to reduce their role or even exit completely And of course, it has to be agreed as part of the process. So I will still remain the CEO of FDS. I'm also going to become a trustee on the trustee board. But as Russ will probably explain to you later, trustee boards must have an independent trustee along with the vendor and another, because obviously the trust is there to act in the best interests of the staff. So at this point, and as you can imagine, some of these processes are running simultaneously, we've got to actually set up the EOT, the trust company. And it's here that our lovely Paul and Russ, as our lawyer and tax experts, come into play to complete all the necessary legal agreements. I mentioned that I am staying on the board of my company, but I'm also, as I mentioned, also staying on the board of trustees. But I cannot be alone on that board because we've got to show that we're completely impartial and acting in the best interests of our staff. Really important and so often missed in this process is a good communications plan. And Poonam, my colleague, will talk to you a little bit about this later, because obviously she was one of the recipients of this communication, being my managing director. And getting this right is very important, because it's almost certain that you will have staff who will not immediately understand either the benefits or the possible issues related to being an owner, although I would say in an EAP, there are no issues that I can immediately think of. But I know when I was debating this with Poonam and my team, they needed to know confidently what their actual position was going forward. And of course, there's lots of great PR around this. So not only do we recommend and assist you in an internal communications plan, but also an external communications plan. And it's on that I will pass over to Poonam to give you a little bit of an insight into how we run the comms plan. Please don't forget, if you've got any questions, please do type them in the question box, or we'll be taking questions at the end. So thank you very much, everybody.
Thank you, Jo. Thank you so much. Hi, everybody. So as Jo has introduced, I'm Poonam Kaur. I'm the Managing Director at FDS and one of the participators of the Employee Ownership Trust that we've just put in place for our business. So I wanted to start, by saying that the communication plan is absolutely crucial in the mix of putting this employee ownership trust in place. It's so important because there's so many opportunities to reap the benefits and ensure the success of the transaction. And what we do at FDS is provide you with a full communications plan that is going to be bespoke to your company. We would make this to ensure that this is going to be in line with the size and structure and also the values of your business. Rachel, can we go on to the next slide? So,
sorry to interrupt. We've had a question saying, will the slides and the recording be shared? And the answer, ladies and gentlemen, is yes, they will.
Brilliant. So just to continue, we take into account that, every business is different. You may have 6 employees or 600 employees or 1,000 employees. And I don't think Jo mentioned already, but John Lewis is a company that has adopted this kind of scheme where it's owned by the employees. So every communication plan will be different due to the size and nature of the business. We will ensure that within the communication plan, which will involve our employee ownership experts, it will include why the business is becoming an EOP, why have we chosen this route, what is the company structure now compared to what it was before. So like Jo explained, our company structure hasn't really changed. The only change is that actually, instead of myself being a shareholder and Jo being a shareholder, we've actually got the EOT itself as a separate shareholder. In terms of the organisation, Jo is remaining to be CEO. I'm still a director, so that's not changed at all. What it means, as part of the plan, we need to explain what it means for the vendors. So, why is this route an acceptable route to the vendor, and what benefits has that provided. We also need to explain what it means for the employees. From our perspective in our company, you know, it was really important to us that we're able to communicate clearly the roles, responsibilities, the risks and liabilities, as well as the benefits of an EOT, just because any change can be a concern, and it's really how you manage that process and manage that change to ensure that actually everybody is focused on and are clear about the outcomes of such a transaction. So, you know, there's a whole process that needs to be followed as part of that communication plan. One of the main questions, you know, was for me when we were looking into it, what is the cost going to be for the employees? Is there cost involved? Do they have to, you know, find money to be part of this EOT? But you know, this is one of the main positives from an EOT, that actually none of the employees need to actually find any of their own money. This is a really good way of passing the business on to the employees. We will also talk about the control. It's important for the vendor to release control of the business. That is one of the main points of an EOT. And what we mean in control is what Joe mentioned, more than 51% has to go as the EOT, and it's the trustees of the EOT that will make the decisions on behalf of the employees. We also will talk about the day-to-day operations of the business and what it means for each individual going forward once this structure has been put in place. And like Joe said, some vendors may want to exit on day one, some may want to stay for a period of time until they've had their full payment from the value of their business. So we would look at that turn in turn. The other things that we would talk about is who are the trustees of the EOT, and as part of this, as Joe mentioned, it's a necessity to have an independent person as part of that. And for us, our independent trustee is Paul from Keebles, and you know, we want to show that independence. However, some companies do choose to have other forms of independence, non-execs on their trustees. Also, you may want to consider having employees as part of that trustees board. And then the other thing that I would mention as part of that communication plan is that we would produce a handover document which explains to new starters what the EOT means. There can be certain levels of acceptance as a participator, so there is certain rules that need to be followed and that are flexible for new starters to become part of the EOT. Rachel, can we go into the next slide? So these are some of the reasons why it is crucial. And you know, if you don't engage with your employees throughout the process, it can have a very adverse effect on the benefits. So a few of the items that we've mentioned here, that you know, staff are not engaged, staff don't understand the mutual benefits of the business, staff don't feel proud of the change in the business, staff productivity will not change. Staff will worry about their reporting lines, and they will worry about, is there any risks and liabilities of being part of an employee ownership trust, and staff retention, they just will not be engaged into the process. So it's crucial that when a plan is put together, we do think about pre, during and post the EOT transition, to ensure that we can really excel on those benefits. Because as Joe said, when we were going through the process, it was we were looking for what is the negatives of this, you know, what does it mean, why how could it adversely affect the business? And I think the only point that we could think is about the execution of the plan. If you don't execute that in the proper manner, then that could really change the outlook of what this scheme could bring to a company. So as part of the EOP communication plan, there'll be a number of steps that will be involved, you know, and we would sit with each individual company and we would discuss how is the information going to be provided to the employees. And again, as you'll probably appreciate, you know, different sizes and structures and having different layers of management may need different kind of communication. So it's how we manage that process per each individual company. We will also look at what steps need to happen at what stage. It's really important that, you know, we put the plan together that minimises any disruption and we maximise any benefits wherever possible. So I think from our perspective, you know, for Jo, it was really important for her, as me as the other director, to be fully on board and fully understood what an EOP was, so I could share it with the wider team, so we both could share it with the wider team. But I think initially, from Jo's perspective, it was really important that, you know, I'm a very risk adverse person, and for her to understand that, right, Poonam, what do you think about this? How do you feel? Do you think this is the way forward? Because we've talked for many years about succession planning, and this really did tick the boxes for us in many, many ways. Also, as part of the communication plan, we need to discuss when will it all happen, how long the process is. So we would put a timeline process in place of all the communications, when they need to happen by, and how it will happen. And as Jo's already mentioned, it's all about looking at internally, but also externally. So as part of our process, you know, we think this is a fantastic scheme in place for a number of companies who are looking at succession planning, and they should definitely consider this. But there's a whole load of PR benefits that you're able to reap from this, because of the whole nature, giving the business to your employees, you know, rewarding your staff. So that's really, really important that we do follow that through from pre, during and post, and we maximise wherever possible.
Thank you very much, Poonam. So Poonam's given you the insight story from a member of staff, and I hope she's made it clear that there are lots of positives, but it has to be handled in the right way. And so while there are some sayings that one lawyer in a room is too many, in terms of Paul, we've worked with Paul on all sorts of transactions, probably dozens and dozens of transactions over the years, and I trust him completely. And he's one of those rare birds, a commercial lawyer. So on that basis, Paul, I'd like to introduce you to do your legal eagle bit.
Thank you very much, Jo. Yeah, I've been telling myself I am the lawyer jam in the Victoria sponge of the accountant speaking this afternoon, which is unusual for us lawyers, because generally speaking, we tend to be the plate on which the cake sits. We're not very interesting, but we're actually quite important and necessary. So I'll be brief, because the interesting stuff really is what Jo, Poonam and Russ are talking about. So the first point really is the question of the trust itself. What vehicle will we use? Jo's already talked about the use of a trustee corporation, and that is by far the most common. But as you probably know, trusts can take any number of different forms. Traditional trust is where you have one or more people who accept personal fiduciary duties in relation to a trust fund from a donor. A trustee corporation is slightly different. It's a limited company, limited by way of guarantee, not by way of a share capital, and that actually becomes the trustee itself. It's obviously administered and run by a board of directors who would effectively be the trustees. And in the case of FDS, as you've heard, though, that includes myself as an independent board member and two of the directors of the business as well. Why do we suggest a trustee corporation? Well, it's much more flexible because it enables you to switch in directors much easier than it would be with a traditional trust. If you have a traditional trust, you need to do a formal deed of appointment and retirement every time you wanted to bring on a new trustee or retire a new trustee. And perhaps, and more importantly, in a traditional trust, the individual trustees take the fiduciary risk and the personal liability. With a trust corporation, it is the trust corporation itself which takes on those duties and those potential risks. And the directors of that company obviously have their fiduciary duties as directors, but don't have any personal liability to the beneficiaries in respect of the trust fund itself.
Just to pause for a minute, Paul.
We've just had a question through saying, can an LLP set up an EOT?
I think it is possible for, I mean, this might be a question as much for us as it is for me, but from a legal point of view, there's no reason why an EOT couldn't acquire a membership interest in an LLP.
Russell?
Yeah, from a tax perspective, you can't do it directly, but there is a route through to do it, which effectively involves incorporating the company first into incorporating the partnership first, and then that company can establish an EOT. So it has to be a sale of shares, but yeah, I can cover that in a little bit more detail when I do the tax side.
Okay, thank you.
And whilst we're just on the questions, Joe, can I just ask another quick question that we've just had in? We've had a question saying, would you suggest a trade sale first and then an EOT if a trade sale doesn't happen?
Well, it depends what sort of, timeline you're wanting. If you're wanting to do this quite quickly, then obviously this is much, much speedier than a trade sale. Poonan and I, when we're selling businesses, and, we're usually selling, well, between 6 and 10 a year. And we say it can take a year to do a transaction, but a year in the corporate finance world is actually only 10 months, because by and large, and I appreciate this is an exceptional year, August and December, nothing happens at all. Also, of course, there's going to be the question of actually finding the buyer, then getting them to the table. And while I think there'll be a lot of bottom fishers out there at the moment, and actually, there is a lot of traction in business sales, it is no doubt going to take easily a good 12 months to do it. The other thing is, obviously, on a trade sale, you are going to pay capital gains tax, and Russ is going to come to this later on. But there are increasing rumours that capital gains tax will be removed, possibly. There's an ongoing review generally on all taxes, and therefore, at very best, you're going to pay 20% tax on the gain. On an EOT, you're going to pay 0. In terms of, which one should you do first, clearly once you've done the EOT, it's difficult for you to benefit from the whole trade sale, but one option would be to do a 51% into an EOT and then do a trade sale on the balance, so at least you've banked some of the benefit of the EOT, and then you look to sell the whole lot, including the EOT. Obviously, the beneficiary of the EOT get their benefit at that time, but you've just banked a bit of certainty.
Yeah, and I'd just add to that with a trade sale, you're more likely to bank a lot more of the money up front than you are via an EOT, because unless you went down the funding route, the benefits of the EOT is that the employee doesn't have to put anything on the table.
So we can fund it. We can fund it.
Brilliant. Thank you. Sorry, Paul, for interrupting.
No, not at all. The next issue I was going to talk about was creation, funding and constitution of the trust. So the trust will be formed by way of a trust deed. This is a document which is executed by the target company and the trustee corporation. It sets out the powers that the trust has in relation to, for example, investment and distribution. It will describe who the beneficiaries are of the trust, and particularly how you qualify or fail to qualify to become a beneficiary. And then we have the deed of contribution, and this is a document which reflects and records the financial contribution which the company is making to the EOT at the date of completion and subsequently. So it is the means by which, if you like, the initial cash consideration and payment of fees are presented and provided to the EOT to enable it to discharge it.
We just had another little question on, is this a product that is transferable internationally? And from a tax point of view, I think you're going to have to answer that, Russell. The principles, of course, like any principle of a business sale, are going to be international, but I've got no idea whether an EOT exists externally to the UK. Russell or Paul, do you know?
Russell's on mute.
Russell, you're on mute, which is the quote of the year.
Yeah, I was blocked from being unmuted. Yeah, I mean, essentially, if the shareholders are UK resident, so they will be subject to UK taxes on the sale of an overseas company, then absolutely, it's that's essentially a UK asset for capital gains tax purposes, and therefore, the EOT, in theory, works. I mean, it's a little bit more difficult. We need to make sure that you tick through all the boxes and meet all the conditions, but in theory, yes, that could work.
So we've just had another very important question, which is just to clear up, can the EOT borrow money to pay out the vendor? And the answer is yes, it absolutely can, as long as the selling company is prepared to give security. And as part of any process that you wish FDS to help with, we can help you identify those funds. I have just chosen not to do that because I didn't want to burden my staff with the debt. But if I had wanted to, we could have gone out and had a facility that would have just been guaranteed by FDS and put into the trust to pay me out straight away. I hope that answers that question. Paul, back to you.
Thanks, Joe. Yes, well, in fact, I'll come on to talk very briefly about the kind of documents we would produce as part of this transaction. So that's the first and most important, is the sale and purchase agreement. So this is the document between the shareholders of the target company and the EOT, which transfers ownership of the shares in the target company to the EOT. It's a critical document because clearly it needs to set out the price, the structure of payment, and so on. It's generally mechanical, in the sense of there's not many contentious or negotiated points on it, unless there is a specific issue of risk, perhaps, where the vendor is accepting that they will be responsible for perhaps a contingent risk in the business. But I would say that's very unusual and by far the exception rather than the rule. Joe's already mentioned funding documents, so it's not uncommon for the EOT to borrow to raise funds for the purchase price. Sometimes that can be from connected parties, sometimes it can be from third-party funders. So we would assist with reviewing the funding documents and to ensure they properly reflect the commercial terms that have been agreed between the borrower and the lender. And then finally, we have the ancillary documents, which is that lovely raft of board minutes, shareholder resolutions, companies house forms, stock transfer forms, all the things that lawyers generally get excited about and no one oddly seems to either. And then finally, as we talk about the ongoing shareholder dynamic, so this is only really relevant in circumstances where a controlling interest is disposed of, but not 100% of the share capital in the target company. And the reason this is relevant, of course, because depending on the size of the minority stake which the vendors retain, they have a legitimate interest in protecting that minority interest going forward. Russ will talk about the qualification or the qualifying criteria to ensure that you benefit from the advantageous CGT rates, but what you need to ensure is that the legitimate interest of the remaining seller's interest doesn't somehow jeopardize, or the treatment of that interest doesn't jeopardize the favorable tax treatment. And in circumstances where a vendor is leaving a significant proportion of the consideration on deferred terms, we also need to consider how that should be protected so far as it can possibly be. And again, in circumstances where the seller doesn't create inadvertently a situation where they are deemed to be controlling the company. So that requires a degree of careful consideration to balance those potentially competing interests, while at the same time ensuring that we don't inadvertently put at risk the tax treatment that you want to achieve. And often what that means is that we arrive at a selection, a list of covenants which the company undertakes to observe and ensures that it does not take those without the consent of the minority seller or the seller with deferred consideration. So instead of having control, active control, you have a form of negative control. So you can prevent the company from doing certain things without your agreement. So I think over to you, Russ.
Thank you very much. Thank you very much, Paul. So to finish up, the saying, death or taxes. So we've chosen taxes today. So, Russell, would you like to just have a go? Just had a little question. How would you treat COVID business interruption in the valuation of a business? Okay, Philip, that is a huge question to answer. But from a valuation point of view, to me, this is a black swan year. And therefore, we would look back at history and probably then look forward. We may even exclude most or all of this year. Funnily enough, I'm just doing this for a business. They're actually going down a trade sale route, and their business has suddenly picked up as everybody's gone back in. But nevertheless, it's going to be a slower start. So we are actually going to treat the whole year as a non-starter. So we just exclude it. And I think because this is clearly a worldwide phenomenon, then I don't think we're going to get any questions on that. And bearing in mind, you're selling it to your own management team, or transfer it to your own management team. I think they more than anybody are going to understand that. Just had a question. I think this is for you, Russ, which is what are the benefits of an EOT versus I can't remember, was it an EBT? Can you see it, Ponan?
I can't see that question, no, Joe.
It was, if the person who just posted that.
Oh, what are the key benefits of an EOT versus EBT?
Yeah, perhaps Russ, you could answer that.
Perhaps just bear with me about 30 seconds.
Right. Okay, so Russ, now just bear in mind, Russ, that tax isn't the most exciting subject.
I'll try and make it exciting.
But what
have you got some magic tricks up your sleeve, Russ?
Yeah.
What is very exciting for vendors is obviously taking their money out tax-free, and for employees, the opportunity to take tax-free bonuses up to a limit.
Yeah, exactly.
So off you go, Russ.
Right, thanks, Joe. Thanks, everyone, and good afternoon. So I will try and make it as exciting as possible, but as Joe said, it's quite difficult when it comes to tax, and it's actually quite difficult when it comes to EOTs, which basically the regulations are quite prescriptive, not very complicated in truth, but quite prescriptive. So there's no other option than to go through each of the regulations and just tick them off one by one. So I'll come on to some of those detailed sort of points in a few minutes, but just to kind of highlight the main tax position that you would be facing if you've got an EOT-owned company. The first one is, has kind of been muted quite a few times now, is that, and the main one for the vendors is that at the moment there is no capital gains tax on the sale of your shares to the trustees. The way that's achieved in the regulations is that if you meet all of the qualifying conditions, then it is treated as a nil gain, nil loss transaction. So essentially your historical base cost in the shares transfers to the trustees. So, the astute amongst you will realise, well, that means is that the trustees effectively don't really have any base cost in the shares, and that's right. And essentially what the vendors are doing is shifting that potential liability to capital gains tax onto the trustees. Now, clearly the expectation is that those trustees will own the shares for many, many years to come, and that's the idea of an EOT, is that the business will be owned by the trustees for many, many years for the benefit of the employees. So the expectation is that inherent capital gains tax wouldn't really ever be crystallised. Technically and in theory, that can be mitigated or avoided by using a non-UK trust, but in practice, my view is they just don't work. For all the reasons that you need. We've sort of discussed a few moments ago around control and the legal ramifications of having a trust. The trustees need to be based in the UK, and I've yet to be able to get one to work with offshore trustees just from a practical reason. I think Joe mentioned previously as well that this is a bit of a one-shot opportunity. So it actually applies to sort of all sales in a particular tax year, but essentially in that first year in which the trustees gain control or the control of the company, any gains or any disposals arising in that tax year would qualify for the nil gain, nil loss treatment. And the main tax benefit for the employees is that they can participate in a tax-free bonus to be paid by the company of up to £3,600 per annum. The fundamental principle on which the trust is established is that it is established for the benefit of all employees on equal terms. Having said that, within those terms, there is some flexibility permitted around three main areas, and that is remuneration level, length of service, and hours worked. So the trust documents can permit the trustees some flexibility to award bonuses based around those criteria. So there is some flexibility. So you're not forced to give everybody 3,600, and you can base it, but on those criteria. But there needs to be fairness across that criteria, across the employee base. Then, in terms of paying bonuses. To the extent that the trustees then, make any other distributions to the employees, then that will be subject to pay-as-you-earn and NIC. And somebody mentioned a few moments ago, what's the benefit of an EOT versus an EBT? Basically, the benefit is twofold. One is obviously on establishing the EOT, there's a tax-free gain available to the vendors, and the other is the £3,600 a year tax-free bonus that is available. But other than that, essentially an EOT is an EBT. There's no real difference. It is an employee benefit trust, and for all other tax purposes, it is taxed as an employee benefit trust. Another key aspect of the EOT is that ordinarily, because you have a trustee company and it's controlled by the trustee company, other tax arrangements, and in particular sort of EMI, enterprise management incentive share option arrangements that are tax efficient schemes to allow you to award shares to employees. Ordinarily, they wouldn't be available, but they are carved out, or the independence test that normally applies to those tax advantage schemes is carved out for EOT-owned companies. So it is possible to still, to sell shares into the EOT, but then still award, really key employees and senior employees with EMI type share options or other share option arrangements, so that they can participate in, separately in the equity of the business, if that's what's desired. Care is needed that doesn't actually end up diluting the ownership of the EOT, but essentially it is possible to award these shares. And I think a question just pops up around an EBT selling to an EOT. It's not necessarily possible for an EBT to sell into an EOT, but depending on how that EBT was first established, there are some sort of particular rules where you can effectively morph yourself into an EOT. So perhaps a little bit too complicated to go in today, but,
yeah.
but essentially,
we could that up, couldn't we, on a separate note, Ross? Victoria.
Yeah, if you've got an EBT, then there are potential opportunities, but it's very specific and it depends on the circumstances. But we can cover that. We can cover that separately.
Brilliant.
And why do I think sort of EOTs are important, and perhaps more important now than ever before? And I think there's kind of two or three reasons really. One is that Entrepreneurs Relief has sort of evolved over the years, and most recently has been reduced down to £1 million annual lifetime limit down from 10 million. So the benefit of ER is an Entrepreneurs Relief, which is essentially a 10% tax rate. So the normal capital gains tax rate is 20%. Entrepreneurs Relief allowed certain vendors to qualify for a 10% tax rate. That has been reduced down from a £10 million limit to a £1 million limit. So the tax-free gain the tax-free gain on the sale to the EOT is obviously very attractive compared to a 20% capital gains tax rate. And I think I think it's fair to say that I think it can be expected with everything that's happened this year, the massive amounts of debt, over 300 billion at the latest count, clearly going to go up over the remaining year, that taxes will have to rise. Capital gains tax is an obvious target, and the reason why it's an obvious target is that the Conservative manifesto said that they will not increase income tax, VAT or corporation taxes. Note very carefully, they didn't include capital gains tax on there. So capital gains tax is a tax that they can raise and still, regardless of COVID-19 pandemic, still point to the Conservative manifesto from the last election and say that we didn't breach that manifesto pledge.
So if I could just ask you just to pause a minute, we've had 3 really interesting questions. The last question was really interesting, is there an upper limit to a valuation? And the answer is absolutely not. The business is, private businesses are valued on the basis ultimately of what a buyer in a trade situation will purchase at and what a seller believes is a fair deal. However, for an EOP, we would want to be comfortable that the revenue are not going to scrutinise this in any way, and that's why it's very important that we do a proper, robust business valuation to demonstrate that we aren't skewing these figures to suit the vendor. But in terms of what it's worth, there is no upper limit. I guess it would be a question of, can the EOT actually afford to pay it either by future profits or by borrowings? The next question also related to that was, if there's cash in the bank, can this be transferred into the EOP? And absolutely, that's exactly what I've done in my own business. I had some excess cash, and it is excess cash. It's not all the cash in the business. So when we value a business, we value it at, well, there's various methods, but let's just call it a multiple of profits. And we call that enterprise value. And on top of that goes any excess cash to make the total consideration. So the total value that you take out of the business is the excess cash plus the enterprise value. And how that is funded can either be through profits or through a fundraise. And the other one was, is there a difference between a trade sale and an EOP valuation? And the difference on a trade sale is you may have a synergistic buyer. So you may have a buyer that can see huge benefits of acquiring you because you've got a sales team that they want, you've got products that they can sell into their customers. Therefore, that can possibly create an added value. We call them secret assets or hidden assets. And clearly with an EOT, you don't get that, because you are leaving the business in the control of the management. But you've got to weigh this up alongside the speed that this can happen and obviously the tax. Another question just popped up then, but it's gone off my screen, Poonan. I don't know if you can see it.
You've mentioned that it's the upper limit. That's what I can say. You've mentioned about if as a vendor I was looking to take a proportion of the cash at bank.
Yeah, I've answered that.
For tax. So I think just on that point, that if it was taken throughout the EOP, there'd be no tax.
Yes, that's what I'm saying. You just transfer it into the EOP.
Yeah.
If we haven't answered the last question that popped up, if the author of that wouldn't mind posting it again, I think we're virtually at the end of this webinar. I think we've just got a few points.
There's one more. There's another slide, Jen.
Sell 100% to the EOP. How do they realise the balance and at what value? Oh, that's a really good question, Mark. And it's exactly what's happened in my business, because I've chosen to sell 89%, keeping an 11% value. Now, that is because my tenure at FDS, I don't intend to be there in the next 10 years, although I think Poonan thinks I'm going to be there in the next 20 years. So the plan would be for the balance of that is when I depart, I can either offer it to the EOT or even offer it to the management or directors as individual owners, or I can just hang on to it and take dividends as the EOT and the business declare dividends. And ultimately, I guess if FDS then sold completely, I could then take a proportion of that total, of the 11% proportion of that sale. But I mean, there are various schools of thought. It depends where you are in your life cycle of your business and your career. You know, you might want to sell 51% and then just hold on to the rest and plan to, you know, do another sale of your personal 49% to another third party, bearing in mind the tax changes that are applicable to that. So I think we would have to talk to you about what suits you most. I'm just giving you my personal input into what I decided. But we've worked with people that have sold the whole lot and others that have just sold 51%. But you've just got to think about the total story.
Yeah, just an important sort of aspect of that sort of surplus cash point and sort of surplus assets and sort of the whole, I guess, contribution and how the funding works if it's all done as an internal transaction is that essentially HMRC see this transaction still is effectively as a management buyout type transaction. So you've still got some important sort of anti-avoidance rules that you need to satisfy HMRC that this is a genuine transaction being carried out for bona fide commercial reasons, so that they don't apply the anti-avoidance rules, which essentially can shift the treatment of the sale proceeds from a capital gain treatment to a dividend.
But that is exactly why, you know, we've assembled this team, and having been through it myself, you know, while it is important to tick each one of these boxes, they are by no means impossible boxes to tick. Yeah. And I say that as somebody who's actually gone through it.
Yeah, it is, and that sort of application of the anti-avoidance rules, obviously, needs to be assessed carefully, and you know, it invariably, you know, it's fine and can be structured around, but that is a fundamental part of the HMRC and tax advance assurance that we would apply for as part of the you know, as part of the transaction. So you know, carefully crafting that, carefully structuring the overall arrangements, you know, presenting that to HMRC in a careful way will, you know, give us the maximum opportunity to get the advance assurance. And that advance assurance is really important, because that gives the vendors comfort that it's going to be treated as a capital gain and therefore a nil gain, nil loss. HMRC are not sort of giving you assurance that you qualify, you meet all the conditions of being an EOT owned business, but they are giving you that assurance that it will be treated as a capital gain. And that's a really valuable piece of you know, correspondence with the HMRC, because it gives you as a vendor great comfort over the overall tax treatment. So
that was a hugely important to me, and I know it was very important to Poonan and the team, because we didn't want anything coming back and biting either them or me. I'm appreciating the fact that we've literally got 5 minutes to go on this. Could I just ask if there's any more questions, if you could post them up and we'll do our best to answer them.
So just going on to the questions, we've had a question saying who gets what share of the EOT? And I think I probably am the best person to share this with you, in the sense, and Russ, please jump in, but Russ picked up on the 3 criteria of the flexibility of the EOT, which includes the level of remuneration, the hours worked, and the
length of service.
So with those 3 things in place, it's quite flexible to structure this to make it appropriate for the level of management and the employees within the company, to try and give that proportion accurately within your current team. So that's how it's done, but in essence that is decided by the trustees of the EOT, and they have to work fairly across the board for all employees on those basis.
And we've just had somebody who wants just to hear the end of Russ's, because I think I cut him off. Yeah, I think the one I cut you off on was the 5% shareholders.
Yeah, so it's worth me just having a quick whiz
on that one
down these key requirements. We've talked about the trustees must gain control, and the revenue look at that on different levels. So they look at voting rights, dividend rights, and the assets in the case of a winding up. So you need to meet all 3 criteria. And And the sort of important bit there, or the bit just to be careful around there, is perhaps where you've got alphabet shares in place. And you can sort of declare different dividends on different classes of shares. You just got to be very careful that you're not going to breach one of those conditions.
Which we did have in our business, but we managed to sort it, didn't we, Russell?
Yeah, absolutely.
Actually, Russ, just to add to that, we've just had a question. Is it correct that the other minority shareholders with more than 5% shareholding are not classed as eligible employees?
Yeah, so they're excluded employees. That's correct. I was going to.
That's the last bullet.
Part of my 5% sort of point here. Yeah. So, that's right. So if you own more than 5% of the shares in the company, or have done in the previous 2 years, then you are an excluded employee from benefiting from the trust. And again, if you've got a family business, you've got to be, you're all connected, so so you can be grouped together. And an important part of this to flag is the type of business that it's available for. So it's a trading company or the holding company of a trading group. This is very common within sort of the tax regime to have particular benefits available to trading companies and not available to investment companies. So if you're a property investment company, an EOP is not available to you. It needs to be a true trading company, not an investment company.
Thank you.
And again, there's just a really sort of nuanced rule that really this is looking at sort of widely owned or widely sort of employed businesses. So again, if you've just got a family business where a few of you are just the family members are working in the business, it's unlikely going to sort of meet the condition that you've essentially got to have a restricted number of shareholders versus employees. Again, that just needs sort of careful review just to make sure that we're below that particular threshold for that. And I think then the only other point I'll perhaps make is that it's really important to sort of maintain the EOP structure. For example, don't dilute the shares and things like that, because as soon as you do that, then you could potentially trigger the gain that's effectively being deferred on the establishing the trust. And if that happens in short order after the sale to the trust, then that tax doesn't necessarily rest on the trustees. It will go back to the vendor. That tax-free gain is ignored for the vendor. So if that happens later down the line, so after a couple of years, then it's the trustees that would pick up that tax. But you just got to be very careful that you don't start to breach some of the conditions. So
this is exactly why we handhold you through the whole process,
yeah.
And because I know these were concerns that Poonan and my staff had, and that's why we're not trying to sell you a one-size-fits-all here. We're saying everything would be tailored and looked at carefully in your own particular business. I am cautious that we've been going an hour now, guys. So is there any other questions, Poonan, that have come through?
No, nothing now, Jo. We've answered everybody's question, I believe.
Okay, so what everybody would like to say, if you do have any more questions, please feel free to email either or any of us. So David's going to say, what are the next steps? If you're interested in talking to us more, please do email us at Poonan. I'll call her mobile number. Clearly, we're still working remotely. We do have an office. I promise you don't work from our back bedroom, although that's where I started. But please do feel to email Poonan, and then we can set up some separate calls with anybody that's interested. And Rach, if you'd just like to go back, just in case any of you are interested, we do have another webinar on Wednesday on crowdfunding, which is a new division that we set up. Crowdfunding is definitely going to be a growing industry for accessing funds in the new post-COVID world as the banks start to shut their doors. So if you'd like to hear about that and the businesses that we're already helping in this area, please do register with Rachel, and we'd love to see you. In the meantime, we would be delighted to have any questions from you, either by email, or if you want to have a Zoom or a Teams call, we'd like to help if we can. So thank you very much, everybody, indeed, for joining us today, and stay safe.